Good morning everyone and welcome to Bond Vigilantes TV. 2018 has so far been a rather mixed year for fixed income investors, with the majority of bond indices posting negative returns. It might surprise some of you that especially the US high yield market has navigated well through a year which was marked by trade tensions, political uncertainty, EM turmoil and, while still strong, a softening of economic data. To give you some context, US high yield has delivered a return of 0.7% year to date, while at the same time the US Treasury index is down 1.1% and the US investment grade index has fallen even more by 2.5%. So how come that the US high yield market has held up so well? What might first come to mind is the shorter interest duration profile of the high yield market, which is with 4 years roughly half as long as the investment grade market. Given the higher credit risk in high yield, investors do usually lend for a shorter period of time. And this has been beneficial in 2018, during which US Treasury yields have tested new highs. But this is only part of the story really. As you can see in this chart, US investment-grade credit spreads have weakened throughout the year, while US high-yield spreads have actually managed to tighten slightly. So what drives this relative weakness in the IG market? Well, first of all, it has to do with index composition. Investment-grade companies have used the record low interest rate environment to lock in low rates for a very long time. This has increased the duration of the index from roughly 5 years back in 2008 to more than 7 now. Plus, the rating composition of the investment grade market has changed too. The index is now skewed to lower rated credits, with BBBs now accounting for more than half of the index weight. As a result of this, the US investment grade index has become more volatile and consequently returns have become more sensitive to credit spread changes than in the past. In contrast, the index composition of the high yield market has only marginally changed over this cycle. But why has the credit risk premium for US high yield issuers not risen, you might ask? I would argue that, and in contrast to many multinational investment grade players, US high yield companies generate a much higher share of revenue from the home market. This has protected them well from political uncertainty in Europe and trade war fears. Another factor that supported the spread level was oil. The price for a barrel of oil rose by 13% year to date to $68, which is comfortably above the break-even point of many high-yield companies. Considering that 15% of the US high-yield index are energy players, this has obviously helped sentiment. Another factor is supply, or the lack of it in the high-yield market, which has supported price levels of late as well. And last but not least, I would also add that all-in yields look attractive for domestic investors, with a yield of currently 6.5%. Now, while nothing points to an immediate weakness, I guess it's fair to say that US high yield looks increasingly expensive on a relative basis. This especially if we compare the compensation for credit risk to the European high yield market. For the first time since 2013, US high yield spreads are trading inside European high yield spreads. And what makes this relationship even more pronounced is the fact that the European high yield market is actually of better credit quality. Also, emerging markets appear to offer relative value. After having briefly traded inside US high yield spreads in Q1 this year, EM high yield has considerably repriced of late and does now offer a compensation for credit risk which is more than 100 basis points higher than the US market. With a view that trade war does not escalate any further, adding back some EM exposure on a selective basis might now be a prudent thing to do, especially against the backdrop of improving EM fundamentals. Thanks very much for tuning in this morning, and bye for now.